All right, my friend. $395,287 investment mistake. Don't do it. I got to get this a little bit more level there. There we go. Not quite level, but it'll be good enough for what we're going to do here today. All right, so we're going to talk about how the mistake is made, how easy it is to make it, how easy it is to avoid it, the reasons that you could be allured into making the mistake, and why you should not. We'll get into all that here in just a second, but I'm just telling you right now, it's a costly mistake, and you don't need to make it. So welcome to the Heritage Wealth Planning YouTube channel, the place where you come to learn how to avoid simple investing mistakes. I'm going to show you the number one mistake that you're going to make. And I'm going to create a lot of enemies in the business as well at the same time. So sorry, but you paid me the big bucks to bring the truth to you. So let's dive right into this. Let me get my trusty wipe here. And we're going to go into this. $395,000. I can hear you saying, Josh, you're crazy. How are you going to make $395,000 investment mistake? Well, we're going to show it to you. So let's start with a portfolio of $250,000. Make sure you can see that. $250. See both? Yes. Okay. So we got two portfolios of $250,000 each. All right. So we're going to use red. Let's use blue. Let's use green and red. So we're going to use red for the portfolio that charges a 1% fee. 1%. And we're going to use green for the portfolio that has no fee. Okay, so no fee. Now, that's all we're doing differently. We're taking two portfolios. Now, what I'm done here is I use my proxy, which is an aggressive portfolio, roughly 80-20 stock to bond mix, 75-25, using my numbers that I think the future will hold, which is, again, a conservative model in terms of performance in the future. Roughly 7.5 stocks, 3.5% bonds. Diversified, rebalanced every year, the whole thing. This is just basic, simple portfolio index funds. Nothing fancy about this whatsoever. But the idea that but there's no other fee. All we're charging is 1% and zero. There's no internal expense ratio, no trading costs, no nothing. It's just a basic fee versus no fees. All right. Now, some people say, oh, but Josh, a fee-based account should be able to give you downside risk protection. Well, we don't see any evidence of that whatsoever. And I just did a video right now where if you're going to show me downside risk protection, I want to see that and how you protected me from downside risk in 2000, 2001, 2002, and October 2007 to March 9th of 2009. I want to see that. If you can't prove that to me, then I mean, where did you show it? And just saying you have a strategy or a process that can do this, or a computer algorithm or something like that. Man, my stomach's growling. That's where I got the mic. You might have just heard my stomach growling because I'm doing this intermittent fasting thing, by the way. So it's 10 o'clock right now. I haven't eaten since 6 p.m. last night. So that would be, try not to eat from 6 till noon. So that's 18 hours. Ooh. Anyway. So that might be true that the downside risk mitigation is your strategy. I want to see it. If you can't show it to me, how do we know what happened? Now they say, well, index funds underperform and downside. There's no evidence of that. There's just not. So part two, well, we can get upside growth benefits in terms of we can outperform. Again, I'd like to see that net of fees. Show me where that has happened and we can talk about it. Show me that you're Warren Buffett or you're Peter Lynch and we can talk about it. But if you can't show me that has happened, the likelihood of you outperforming given your fee is so small, it's just not worth the risk. It's certainly not worth the money it's going to cost me. Again, that's my opinion. I'm open to suggestions otherwise. Show them it to me. But I shared with you in the last video of what you can do to mitigate against downside risk protection, downside risk. And there are strategies to do that for sure. But if any time you're trying to protect the down, you're limiting the up. Anyone who says otherwise is full of crap. There's no other way around that. To get the reward, you have to take the risk. To eliminate the risk to some degree, you have to lessen the reward. Those things are mutually exclusive. You can't get more reward and less risk. It can't. One of the things has to be, there's no other way around that. And again, the last video I showed you like a company like Swan. I think they're out of Phoenix. And hey, I'm a fan of it. They do downside risk mitigation. And has proven themselves to have done that successfully. But when they do, they also have upside risk ceilings. Upside growth ceilings. There's just no other way around that. So, all right, let's dive right into this. So I said, okay, $250,000 is 2019 today. So let's start with 2019. All right, here we go to 2029, 2039, and 2044. All right, so 2019, you can see all that? Yeah, I just did this video and I didn't make it big enough to see. So we're going to go for 25 years. And so basically with this portfolio, and again, this is just based on a proxy, nothing fancy. On top of that, real quick, active managers who are using ETFs, all right, that's essentially index funds with zero or small fees. Their whole premise is that they can do something that you can't do because they are buying index funds to minimize the risk and minimize their fees. I get that, but they're not minimizing your fee that you pay. They're minimizing the fee that they're paying to the investment manufacturer, the mutual fund company, or the ETF provider. They're still keeping their fee. And what's the auspices of them keeping that fee when they're buying you index funds? Well, it can only be one of two things. Either they're going to outperform in the upside, or they're outperform on the downside to protect you from your downside risk or give you better returns on the upside. One of those two things. That's what they're going to do. If you're hiring an investment firm to manage your money, two things are you're trying to accomplish two things. Give you outperformance, one, or protect you from down performance, two. That's it. Now, a lot of things, this annoys me to no end. Oh, we're going to protect you from yourself. I hate that. That's what everybody's saying. Behavior management. We're going to protect you from making the big mistake. And this, drives me crazy. There's just not that much evidence that most people make the big mistake. And the big mistake is selling in 2009 instead of buying, or buying in 2007 instead of selling. And so the idea is we're going to protect you from doing that. And I've been in this business a long time. I just don't see a preponderance of evidence that the vast majority of investors do these kind of things. I think most people just get in there and they stay with it and they just ride it out. I think most people are actually better than the professional investment class at doing this. And so because of that, this whole thing of behavioral management, I'm going to protect you from making a big mistake, I think it's not for the average investor. I think it's actually for the investment professionals, because they're the ones bouncing in and out, and they don't do it successfully. All right, so let's go back to this. So we got our no-fee guy in 2029, his $250,000 went to 532,064. What did our fee guy go to? Can I just put that on the back here? Yeah, sweet. Our fee guy, though, went to 479,882. 479,882. All right. So you can see already getting a pretty big difference there. What's that? $52,000. So 52K. All right, so now 2029, because I got my red out here, 2039, excuse me, our fee guy went to 153,623. Our no fee guy, on the other hand, was at 174. Oops, just dropped something. 174,1814. And that's a difference of, what's that, $200,000, something like that? Yeah, right about $180,000. All right. Now, in 2044, because that's 25 years, this guy's at 305,3021. And this guy is at 265. Okay, 265,734. And that's the difference of, what did I say, $395,000. All right, so the question I have to ask you, my friends, who's better off? Well, I mean, $400,000. That's either yours or it's your investment guy's. There's no other way around that. Have you hired the investment guy to pay you in order for you to pay $400,000 over the course of that 25 years? And if you think about it like that, you paid $400,000, and this is without trading costs. This is, I mean, because don't forget, an investor, also investment guy, also gonna have trading costs, which might be 5 basis points, but $400,000 over the course of 25 years, that's $16,000 a year, man. I mean, that's real money, my friend. $16,000 a year. Is it worth it? Now, again, we're just assuming it's an apples-to-apples comparison. Low expense ratios on the funds that you have in your portfolio. Actually, in this case, no expense ratios. No trading costs, no capital gains, no distributions, nothing like that. This just assumes that your portfolio is going up relative to each other at the same capacity, just one has a 1% fee and one doesn't. Now, don't forget, when you're taking the 1% a year out, it's coming out from your portfolio most likely. I guarantee you're not stroking a check. So because of that, that's going to have another diminished return because you have to pay fees to sell the portfolio. Now, if it's an IRA, you don't, which I never understood. But the tax code says if it's an IRA, the fees come out pre-tax, which is nice. But either way, your portfolio is being reduced by the amount of the fee, which is why you have a $395,000 difference. Don't make that mistake. Watch my other video I just did on VASGX to use as your proxy to compare your investments to. Can you beat that? Can you underperform or outperform it on the downside? Can you outperform on the upside? Can you stay the course in that by hiring an investment manager to do that for you as opposed to just doing it on your own? I don't think so. I don't think it's worth it. This isn't to bash the industry. I know I'm making enemies on here, but I really, the industry should not charge fees if you're going to do financial planning for assets under management. It just bothers me to no end because financial planning and investment management are not the same thing. Investment management can be done on your own, excluding being an a financial planner. You don't need to hire somebody to do it because most likely you're going to underperform and you're going to overpay. Now, financial planning, on the other hand, can you do that on your own? Sure. But you want an expert who knows how to do financial planning. If you do, you should pay that person, but you should pay just like you pay your accountant or your attorney. I mean, I don't get why this is so difficult for people in our business to see. But what they offer for investment management is they're going to say, well, I can manage your money and do one of those two things. Or I guess the third thing is to keep you in the market from making that big mistake. Behavioral management, upside outperformance, downside risk mitigation. One of those three things. And it's not just simply, there's no track record of that happening. There's not. If they give you the Dalbar study, I forgot what Dalbar stands for, that has been disputed so many ways to Sunday that the average investor doesn't return what the average investor's investment does. That's just been, don't fall for it because, again, are you the average investor? I don't think so. I think you are you. Maybe that guy down the street did the big mistake, but did you do it? And did you sell in 2009? And if you did you get back in or not? If you're sitting on cash, all that stuff would have to be quantified if it's worth to pay $395,000 over the course of 25 years on a $250,000 portfolio. I just don't think it is. All right. So as always, if you like what you see, subscribe. Comments, concerns, questions, always welcome. Thumbs up. My goodness, give them away. Comment, fire away. I love to hear them. And we'll see you guys next time. Thanks now.